Explain how a leveraged ESOP works. What are the advantages?
Okay, so,
Georgia is asking.
okay, well, a leverage ESOP is basically works like this. Instead of going out and buying and finding a buyer for your business who's going to buy your company with cash, what you're going to do is you're going to create a trust, and that trust is the buyer. And you're going to sell the business to the trust in a leverage buyout. And what'll happen is the value of those shares will be paid off over time out of the cash flows of the business. The cash flows are enhanced by eliminating income tax on the business. And then over time, what will happen is the company will buy itself out and pay off the selling shareholders. And obviously, the benefits are many of the benefits that I described, which is for the selling shareholders the ability to quietly and confidentially and on their own terms start to harvest the value of their business, pull the money off the table, convert it to liquid wealth so they can diversify their holdings while continuing to operate and control their business into the future.
Anthony, the idea of leverage comes from the borrowed money. It's not money that someone already has. They went and borrowed it, and they're leveraging the fact that they have to repay that loan. And so
Yeah,
that's
I
leverage.
think, Paul, maybe what we'll do is this. I'm actually going to show some additional slides to describe the structure so people understand how it works. Um, and I'll try to move through this relatively quickly. But it is complicated, and if anybody really wants to go down this rabbit hole, reach out to me and I'll walk you through this in a slower way. But here are the constituents of a transaction. Obviously, the shareholders are the owners of the company. The company itself, this entity, the ESOP Trust, is the buyer of the business. It has been created, brought into existence specifically to facilitate this transaction. And then, of course, the employees are a stakeholder group, and a bank can participate. We'll explain how that works. The initial sale itself is simply the shareholders selling their shares to the trust in return for a note. So upon closing this transaction, all that's happened is the shares have been sold to the trust, and the shareholders have received a note from the trust in return for that share sale. No money has changed hands. Immediately after that, the company assumes the obligation of the note to the shareholders. So what this means is the company now owes the shareholders the full value of the sale price. In return, the trust owes the company. And this is done this way to allow for a different amortization period on the outside loan between the company and the shareholders, and the inside loan between the ESOP and the company. And now what the companies, the shareholders now have notes from the company, not from the trust. So they're in a more secure position because the company is ultimately the entity that's generating cash. The next thing that happens is, I mentioned that the shareholders can receive significant cash at closing. The way that's done is the company goes to a bank and borrows whatever it can, let's say 2 times EBITDA, just for sake of illustration. Then it uses those proceeds to pay down the first tranche of this outside loan. And so now what's happened is the sellers have received this cash and they're sitting on these notes. And in this way, they've received some cash at close, some portion of the notes have been paid down, they're still earning interest off of these notes, and they've received some cash through this bank funding facility. Every year, the company pays off the bank from profits, and those, by the way, those profits are enhanced by not paying any taxes. And so once the bank is paid off, then essentially, once the bank's paid off, the company goes back to the bank, reloads, and pays off the next tranche of notes to the sellers. And so the sellers pull their money off the table in these multiple credit events, or they can just simply carry the notes and get paid from the company directly. This is part of the flexibility and customization in the transaction, that you can either use this bank facility or not. It just depends on the cadence by which you want to pull the money off the table. Every year, what will happen then is the company makes contributions to the trust, think of that as a contribution to fund their retirement plan, and then the trust takes that money that was contributed to the trust and it returns it to the company as a payment on this inside note. And that payment, that amortization of this inside loan, basically meters out the shares of the trust into employee accounts. So as this loan gets paid off, the trust releases shares into employee accounts. And the employees receive statements every year showing how many shares have been granted, released into their accounts, and the value of those shares. And then ultimately what happens is when employees leave the company, whether they retire, whether they resign, under whatever circumstances they leave the company, they sell their shares back to the trust and cash out. And ultimately, that's how the employees get their benefit. And that's the structure of an ESOP. It's a bit of an eye chart, but it's, and you know, some people have referred to this as financial engineering, and you know, and it most certainly is, but this is how it works.